day, fellow investors. We continue with our summary of Peter Lynch's book One Up on Wall Street, and today we discuss perhaps the key tool that he used when it comes to investing: earnings, earnings, and earnings. Because if we quote Buffett, investment returns are perfectly correlated to the performance of the underlying business. And the performance is measured through earnings, through the earnings line. If we take a look at the S&P 500 in blue and the earnings line of the S&P 500 in white, you can see that over the long term there is a pretty good correlation with periodical ups and downs. So we had a divergence here, 1990s, the dot-com bubble. Not that much of a divergence in the 2000s as it was a housing bubble, and you can see how over, 25 years, up till 2013, stock market returns were strongly correlated to earnings, how earnings move. This is the earnings line, and this is the key when it comes to long-term investing returns. Now, given the zero interest rates, given the stimulus, we have a new epic bubble that we discussed in another video that I'll put the link to the video in the description below if you want to watch that. This will likely, over time, converge again to the earnings line. This up is the lower corporate taxes in 2018 that Trump installed. Now we had the COVID crisis, now they are back. But over the very long term, and we'll do more examples, this is correlated. We're going to do examples: Berkshire, Coca-cola, Intel that recently come out with earnings, so it's a good example. And we're going to discuss also the price-earnings ratio that's responsible for those divergences, how to input all of this into the intrinsic table that we already discussed in another video, link in the description below also, with the downloadable intrinsic table. And then we're going to conclude with the future earnings, because that is what matters, and how to implement it all. And I hope you get a lot of value from this. If you do, please click that like button for the YouTube algorithm and share the video with anybody you might think would find this interesting. Also, this is part of my free comprehensive stock market investing course. This is my research platform. This is for investors. And this is for those who want to learn about investing. You can enroll in the course for free. It will always be free. And there are a few lectures there, and whenever I do something I add here and I send you an email, so you can enroll here if you are interested in learning more. With Berkshire, and this is very nice. This is from the Warren Buffett 1980 earnings letter, and in 1980 Berkshire had earnings of $53 million. If we look at Berkshire's earnings now, over the last years, we see this 10, 12, 12, going to 20, 24, and then when the accounting rules changed, when they have to include their ups and downs of the stock market portfolio in the earnings, those become very volatile. But a flat year, we can say that earnings are reported at 24 billion for Berkshire. This leads to the following. We had Berkshire going from 50 million to 24 billion in earnings. If I divide 24 billion with 50 million, it's 480. If I look at the stock price in 1981 that reflected 1980 earnings, multiply it with 480, I get to a stock price of 249,600. Of course, now valuations are a little bit higher, but you can see how earnings growth relates perfectly with the stock price, and we even were here, and if valuations go down, it will be back to this level. So it's clear that long-term investing returns depend on earnings, earnings, earnings. And if you focus on earnings, you are an investor, and it makes simply investing much, much easier than anything else. You focus on the business, you are a business owner, you focus on the earnings that you get that create value for you as a business owner, and that earnings line is the same as your stock market investing returns. So you can decide whether you want to focus on stock prices going up, I made 20% here, I made this or that, or you can focus on simply owning a business. And perhaps the best example of business ownership is Coca-Cola. This is the net income for Coca-Cola over the years, and we are now at, let's say, around $9 billion. When the company went public in 1919, the profits were $4.1 million. So we went from 4 million to $9 billion. When I divide that, I get that earnings expanded 2,195 times, or we can say compounded at an average rate of 8% per year over 100 years. Important to mention here that one stock at the IPO was worth $40, and after stock splits, now if you owned one stock 100 years ago, now you would have 9,216 stocks of Coca-Cola. If we look at the price, 9,216 times, what's this, 48, 49, 50 bucks, we get to a total of $451,000. So one stock of $40 would now turn into $400,000. And here I have a nice chart from Comgest that calculated it up to 2013. So if you reinvest the dividends that are part of those earnings, the initial $40 of one share would be 11.5 million in 2013, and I have adjusted this for the dividends and returns since 2013, so that's up to 16.72 million now in 2021. So over 100 years, from $40 to 16 million, just owning one stock. And this is the power of earnings. As we said, earnings compounded 8% over the years, and returns were around, now a little bit lower, 13 point something percent per year. And if we look at the dividend yield over the century, we see that it was also 7%, 6%, depending on the sentiment in the market. In the dot-com bubble, it was 1%, now it's again to 3.4%. Of course, Coca-Cola is growing at a slower rate than in history. But if we add 4 or 5% dividend to the earnings compounding, then we get to this historical growth rate. So again, earnings and dividends have perfectly explain returns with Coca-Cola. Now let's talk about the price to earnings ratio. We have the earnings that are the fundamentals, then you compare those earnings to the price of the stock and you get the PE ratio, the price to earnings ratio, that has a very important but shorter term role than earnings. If we look at the S&P 500, you see these divergences from the earnings line that happen when the price-earnings ratio expands over certain periods of time. Then it contracts when there is a bear market again. And you see this volatility of the price-earnings ratio because investors here are pessimistic. Here the price-earnings ratio was below 15, and then prior to the COVID crisis, it went to above 20. This expansion is what makes the returns. Also, you can see in the 1980s, begin 1980s, the price-earnings ratio of the stock market was just 7. Of course, as it went from 7 to, let's say, 20, expanded 3 times, also it means that it's 3 times more expensive to buy stocks than it was, of course, in the 1980s. Then again, on the price-earnings ratio, when there is a crisis and when there are no earnings, then it really explodes. So it's not really a measure to take into account on a given day. Perhaps better is the Shiller price-earnings ratio that takes into account 10 years of average earnings. So we have the S&P 500 here, and here we see what is the relation to the stock price, the S&P 500 level, and its earnings. And you can see here, and its average 10-year earnings. So it was at 15 in 2009, and now we are at 34. which means that the current level of the S&P 500 reflects 35 times the average earnings over the last 10 years. Of course, we are in a bubble because of low interest rates, if the bubble bursts, of course, and the Shiller ratio, the CAPE ratio, is higher now than it was in 1929. If interest rates start to go up, the price-earnings ratio will go down and the market might crash very, very badly. How badly it can crash? See here, the market was down to 666 points somewhere in 2009. That's a lot of downside from this level. But also the price-earnings ratio, the CAPE ratio, was much, much lower. Of course, earnings expanded over the years, but still, if this goes down to 1,500, that's still a 60–70% possible decline. We can hope earnings will not decline. This is from Yardeni Research, and you see here the estimations for the earnings. In 2019, earnings were 163 points compared to the S&P 500. Then we had the COVID decline in earnings, not even that big of a decline, but the expectations are that earnings will grow in 2021 and even more in 2022. And if you look at the market is always pricing in what will happen in the future, not what happened in the past. So the market is thinking that S&P 500 earnings will be 195 in 2022. If we compare 195 with the current level of the S&P 500, we get to a price-earnings ratio of around 20. Price-earnings ratio of 20 compared to the earnings gives you an earnings yield of 5%. 5% returns are something good in this zero interest rate environment. Plus, if earnings grow 2% per year, which has been the historical average, then you are at 6–7% returns. The only problem is that usually these estimates are always too exuberant because analysts were expecting the same earnings as in 2022 already in 2020. This 163 had to go to 190. It didn't happen. So always be careful with these exuberant analysts' expectations. But the key is that future earnings are what matter. And the company that recently reported earnings this week, and I've done a video I think 3–4 months ago, if you haven't seen it, it will be again in the description below, is Intel. And we can see that earnings were stable for a lot of years and then those went up, doubled, and here we have, this is the Intel earnings line, depending on the price-earnings ratio, we are now at 22 billion in earnings, but then again, it's about future earnings. And how to analyze this? Well, when we discussed the intrinsic value of a company, we have made this table. Also, you can download it in the description below if you want to play around. And then the future earnings, you put them, or the cash flows, I prefer cash flows, you put them here, you estimate the future growth rate as we have seen with Coca-cola and everything, Berkshire, because this is what drives returns, and then you put a discount rate, what is your required return. But let's say that Intel has 20 billion of earnings now and that they grow those earnings at 4% over the next 10 years, then for a 10% discount rate based on those earnings, we have an intrinsic value of 313 billion. Compared to the market capitalization of 232 billion, we can say that Intel is undervalued, but there is a lot of sentiment and there is a lot of uncertainty here, so we can be more conservative and we can put a 15 here, which immediately puts down the intrinsic value at 235 billion, which is still good because we expect 10% discount rate. Perhaps it will be lower over time because of the higher competition, which means that it can also be at 100. And this is also the risk, because if things turn negative. And this is how you can estimate your long-term returns. The more conservative you are, the more weight you can put on the negative scenario. depending on where you are as an investor. So risk reward, that is investing, but the key is to watch the intrinsic earnings line over time, because over the very long term, that is what determines your investment returns. Thank you for watching. Like this, subscribe if you haven't. Don't forget to check my free stock market investing course, where there is also a written version of most of the lectures. So thank you. Like, share, and I'll see you in the next video.